Matt Taibbi from Rolling Stone joins us again. Matt, how are you?
How's it going?
Excellent. Another great article, The Great American Bubble Machine, about Goldman Sachs. Let's get started this way. For those for the people out there that are not familiar with the term bubble, well, what exactly is a bubble?
Well, I mean, a typical speculative bubble is when, the classic example was, the tulips in Holland in the 17th century when there was so much demand for this new product, tulips that were being imported into the country, that people were speculating on the future price of tulips to the point where, they cost more than a house after a couple of years. So basically, the speculative demand for a product increases to an insane degree, and it drives up prices. And when the prices become irrational, eventually they bust, and everybody loses a ton of money, and we all get killed. That's sort of what a bubble is.
And now, you wrote about 6 instances where Goldman Sachs specifically created different bubbles that they took advantage of, and that blew up in everybody else's faces. Let's take the example of oil as an illustrative case of how these bubbles operate and how they set them up and how they profit from them. So tell us about what they did with oil.
Well, the first thing we have to make clear is last year, I'm sure you remember that the price of gasoline soared. It went up to $4.50 or $4.40 in some places. At the time, everybody blamed this on a typical supply and demand issue, but in fact, supply was actually up last year and demand was actually down. So the price of gas should have decreased. What was actually going on last year was that because of the housing market had collapsed, the investment banks were encouraging all the people who had been investing in mortgages to now invest in commodities, which include oil. And so what happened at the height of the boom last summer, every barrel of oil that was consumed in the United States was traded 27 times before it was consumed. So that created this enormous artificial demand for future barrels of oil, which in turn drove up the current price of oil. So despite the fact that we were using less oil and there was more oil to sell, we were paying far more for gas than we should have been. And Goldman Sachs was right in the middle of that for a variety of reasons. But that's basically what happened last year.
So, Matt, how do they make money off that, and what are the ramifications?
Well, they make money, it's just gambling, really is all it is. I mean, you have a commodity that's at X price, and it bids up, and you bet that it's going to keep going up. And Goldman Sachs' analysts were continually urging people to continue buying gasoline. It ended up, the price of oil ended up going up to $147 a barrel, which is just insane. Goldman was actually saying that it was going to go up to $200 a barrel last year. Whereas the real price of oil, as we found out, this year when it went bust, was around $30 a barrel. That's where it was at the beginning of this year after it all collapsed. So, it's just another speculative mania where they were encouraging people to bet on a continually rising commodity, and they got out in time, and everybody else didn't.
Right, but that's a key part of it there. How come they don't go bust like everybody else? How do they get out in time? How does that part of it work?
Well, in the case of a classic example was in the internet years where you had a similar situation developing. They had information that other people didn't. I mean, they obviously knew that the real price of gasoline was not that high. They knew that this couldn't go on forever, but they also, let's not forget, they were going to make money whether they got out on time or not, because they were a part owner of the exchange where these commodities are traded. They're heavily invested in refineries and companies that warehouse crude oil. So just the sheer volume of trading was going to make them money, regardless of whether they made the correct bets or not.
So who gets crushed here? Is it the average investor who bought oil at 137 thinking it's going to go up? It goes up to 147, they're feeling pretty good, and then boom, it comes down to 70, and they've lost all their money. Is it just them, or does it have other ramifications throughout the world too?
There are primarily two groups of people that got killed in the commodities bust. One was everybody, because everybody uses oil to some degree. Anybody who had to pay for heating oil last summer, anybody who had to fill a tank of gas last summer, those people were paying a hidden vig to Goldman Sachs and Morgan Stanley because the price of oil was far higher than it should have been. The other people who got killed last year in this whole business were the institutional investors who were buying commodities. So what happens is investment banks go to, for instance, a pension fund or, like a foreign teachers union or something like that, and they say, hey, we've got a really great investment for you. We think you should buy oil commodities. We think they're going to go up, to $200 a barrel, and you should get in now while in the ground floor. And so they sell a mountain of this stuff to these, gigantic institutional investors. They buy it, and when the price drops instead of rises, all of a sudden the people who are holding pensions have less money left in their pension fund, and those are the people who really got hurt.
Well, haven't the people who run these pension funds learned their lesson yet? Or, why do they continue to be suckers and buy into Goldman's game when everybody, the jig is up? Don't we know what Goldman's game, how could they not know what Goldman's game is?
Well, first of all, a lot of the people who run these pension funds are state bureaucrats who are making, $75,000 or $150,000 a year, and a couple of times a year, some executives from Goldman Sachs will give them a call and they'll say, hey, how'd you like tickets to the Super Bowl, or how'd you like to go out to, Spagos tonight, or, whatever it is. These guys, they wine and dine these state employees. And there's all kinds of different schemes through which these guys who run these various funds are compensated for their decision to go in with these investment schemes. But the basic dynamic here is that there are basically these provincial rubes who are overtaken by these slick Wall Street hustlers who end up milking these public funds for everything they're worth.
We're talking to Matt Taibbi from Rolling Stone. He wrote Inside the Great American Bubble Machine, basically how Goldman Sachs has engineered every major market manipulation since the Great Depression. Now, about that, Matt, is that a little too broad, or actually maybe too specific? Aren't other investment banks doing this as well? Are we putting too much of the blame just on Goldman Sachs?
Oh yeah, it's obviously hyperbolic to say that Goldman Sachs is solely responsible for every, disaster that we've dealt with in the last, 100 years or something like that. What's not hyperbolic is to say that they played an important role in all of them, and in some of them, it's very easy to say that they played a leading role. In the internet bubble, for instance, Goldman was by far the number one underwriter of internet IPOs. In fact, at the height of the internet boom, they were underwriting 1 out of every 5 new internet IPOs. So they were the massive, they were responsible for an enormous volume of these transactions. And let's not forget that, the internet bust ended up losing something like $6 trillion of wealth on the NASDAQ. And if you, figure that a fifth of that was somehow related to Goldman Sachs, or maybe even a little bit more, that's an enormous amount of money.
Yeah, and but as you point out, they didn't go bust. They made more money out of that, and they've set up a system where they win either way. By the way, has there been any blowback from this article towards you? Any Goldman executives come knocking on your door?
No, there's been obviously a media backlash, but what I found that's kind of interesting is that I think there's a bit of a sea change in the mainstream media now about the way Wall Street is covered. A couple of years ago, if Goldman Sachs had come out with a $3.44 billion second quarter profit number like they did earlier this week, the normal mainstream media would have said, hey, this is great news for the economy, and let's look at this. Wall Street is booming, so everybody's doing great. What happened this week is, the coverage was, hey, Goldman Sachs made this massive profit. What does this mean? And, that we wouldn't even have that question being asked a couple of years ago, and it's being asked now, and I think that's interesting. I don't think it has, so much to do with me, as there's just something in the air now in the press where, they're looking at this a little bit differently than they used to.
I think it's a combination of things, though. Your article is quoted by just about everybody on this issue. So that's why I asked. Goldman hasn't said a word to you? No lawyers, hey, you better watch it, etc., nothing?
Well, first of all, before we went to print with this article, we gave Goldman Sachs every opportunity to educate us as to any place where we might be wrong in the article, and we sent them a list of pretty simple factual questions to see if they wanted to engage us in any of those issues. They flatly refused, and in fact they implied that the tone of our questions implied that we didn't know what we were talking about and we were ignorant. So they haven't yet. They've made some public statements in response to this article, but they haven't yet taken factual issue with anything that's been in the article. They've called it conspiracy theories, they've called it fiction, but specifically they haven't said anything at all. And in terms of legal action, I mean, I can't even imagine where they would go with that. There's nothing actionable in the piece, at all. So, and they haven't made any indication that they're interested in doing that at all.
Right. I was just curious about that. So now you mentioned the massive profits that they announced for the last quarter,
Right.
just this week. Now, one other thing that was in that announcement was that they're putting aside $18 billion to give to their employees at the end of the year, right? Now,
Yeah.
that's most of their profits, to say the least.
Right.
Maybe even more. I don't even understand how they could take out $18 billion, because that seems to be more than what they're going to have
No,
in profits.
that doesn't count. That doesn't include their profits. That's a cost. That's not part of the profit.
Oh, I see. Okay. Then they're going to get the profits on top, too.
Right.
Okay.
Right. So imagine being a Goldman Sachs shareholder and seeing that. So.
No, but that's part of my question. Why isn't Warren Buffett's a shareholder of Goldman Sachs? Why isn't he saying, whoa, 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 what's with this taking out $18 billion in pay? That's nonsense. You're looting the bank.
Yeah. I mean, the Goldman Sachs shareholders should be mortified that this is happening for a variety of reasons. Not only is the bank awarding itself massive bonuses, but they've also cranked up their risk portfolio, their amount of risk in their balance sheet to even more unsafe levels. So whereas you would have thought last year that you would have wanted the bank to become more conservative given what happened last year. Instead, they've become far more aggressive, and they've put the shareholder at risk and made themselves money and bonuses in the process. But what's really offensive about the bonuses isn't so much that the shareholders should be upset. The taxpayers are the people who should be furious, because what really happened with these bonuses, it's almost a pure state subsidy, these bonuses. It came almost directly out of our pockets, and that's what people don't really understand.
Well, there's two aspects to that. One is that, $13 billion went to Goldman Sachs through AIG, and, of course, we, the taxpayers, gave them that $13 billion, and as soon as we give it to them, of course, they're going to take it home and run, because they don't want it to get pulled back. So that's definitely a part of it. The second part of it is what I wrote about last night. It's an article we put up on our website on theyoungturks.com. What if Goldman went and bust now? What if they say, we took too many risks, what could we do? And it turns out this thing collapsed. Don't they know for a fact that we would bail them out again so that there's absolutely no downside to their taking more risks, but they could make more money?
Well, yeah, exactly. I mean, I talked to Simon Johnson, who's a professor at MIT. He used to work for the IMF, and I asked him, does Goldman have an implicit advantage in the market because everybody knows now that the government's never going to let Goldman go out of business? And he goes, no, they don't have an implicit advantage. They have an explicit advantage at this point. It's not just what happened with AIG and that bailout. It's not just the TARP, where they got $10 billion there. It's a whole galaxy of state support that they've received in the last year or so. Most notably being FDIC backing for $28 billion in new debt, which is basically just giving them a spigot with an unlimited mountain of free money that they then lend back on the economy at much higher rates. It's they might as well put a taxpayer-funded ATM machine in front of their office. So they know that they have government backing whenever they want it. They know they're never going to go out of business as long as they have all these friends in office. And as a result, how hard is it to sell, shareholders or people who are interested in buying their stock on the notion that the stock is going to go up if they know that they have the implicit backing of the United States government? It's a rigged game. It's hard to be impressed with the rise in their share price given that reality.
One more thing about that, which is that there's a possibility that $18 billion they're taking out for themselves might be the last bubble, and that's the Goldman bubble.
Right.
And, you mentioned in the article that it's like a watermelon dropping out of a window and everybody takes a piece because they know at the bottom it's going to go splat. I wonder, the minute I saw that $18 billion being taken out by the employees, I thought, do they know it's going to go splat and they want to take the money out before it does?
Well, they've been taken out, similar percentages, for going back many years. I mean, it hasn't been quite this obscene, but they've been taking out a pretty massive, amounts of money in compensation. I think the average compensation now is going to be $770,000 an employee, but it was $660 a year ago. It's been up around that area. I think they think that this is going to go on forever, and they might be right in that area. Well, at least for the near future, it's going to continue to be like this. So long as they have this implicit backing of the government.
We're talking to Matt Taibbi from Rolling Stone magazine. His article, Inside the Great American Bubble Machine, of course, can be found on rollingstone.com, and we've got a link up to it at theyoungturks.com. Final question for you, Matt. I know this is a very hard one, but what can we do about it? I mean, are our hands tied, and Goldman's going to continue to game the system and take our money till the end of time?
Well, they obviously have a lot of influence with the mainstream of the Democratic Party, but there are people in Congress who are very game for a fight about this. A great example is Bernie Sanders, who, when Barack Obama nominated Gary Gensler, a former Goldman Sachs banker, to the head of the CFTC, which regulates the commodities market, including the oil markets, Sanders balked and said, I'm not going to agree to this guy's nomination until he agrees to put in stiff new reforms to prevent a new commodities bubble. And Gensler, to his credit, agreed to push through those reforms, and he's supporting them now. But Sanders agreed to lift the hold on his nomination. And so that's, if you write your congressman, if you put pressure and you show that you're upset about this and you understand these issues, people are going to start to hear that outrage in the public. And I think that there are a lot of people in Congress who understand what the deal is here, but they're just afraid. They're more afraid right now to cross Goldman and their campaign contributions than they are to cross the public. And if we change that equation, then things might happen. Right.
And of course, Goldman gives more campaign contributions than any other company in America. So
right.
That's a part and parcel of why they're afraid of that. Matt Taibbi from Rolling Stone magazine, thanks so much for joining us. I really appreciate it.
Watch more clips at theyoungturks.com.